Good Monday. This is Jay Brew, co-chairman of Seafreedom Brew. Well, last week's webcast we concentrated on the efficiency ratio. And one of the questions that we looked at was from the standpoint of margin, and that margins have remained relatively consistent in here, looking at it through the end of the fourth quarter, is that where we've had some ups and downs, that essentially that consistency is questionable whether or not, if interest rates continue to move in either direction, that most likely the margins are not going to return to where they were 10 years ago. And when we think about that, we talked last week in terms of how that's affected ROA. No longer the 1% ROAs, but more the average for the National Community Bank benchmark being more like 0.83%. So are we going to have any movement in the margin if interest rates stay where they are? Well, when we look at trend on yield and earning assets, is that there was a slight downward move this past quarter. All during the last couple quarters of the year, there had been a small upward move, but once again, you could sit there and say it stayed fairly constant in here. And then the question is, we had a small move down in terms of cost of funds, which has been a continuing trend, but now it's flattened itself out compared to prior years. And the question is, can that cost of funds go down more for the national benchmark group? I believe they could, but I've been saying that for a long time, that I think the industry is paying up somewhat for rates, but I think based upon realistic expectations is that there's not going to be a lot of move in cost of funds or the yield on earning assets. So when we look at that on an overall basis, the strategy, as we talked about, is that to get that net interest income to stay even or to even go up. In the beginning of the year, we talked about the strategy to grow loans faster in here and faster than asset growth. But the question is that will that actually move us forward, getting us to a 1% ROA, which was the old standard? And I think from a strategic standpoint, watching that net interest income is very important. But I think that the strategy has to be to essentially play with net overhead being the difference between non-interest income and non-interest expense. We can see in here that based upon the current levels of net overhead being above that 2% level, that once again a strategy for the national group would to be moving us down closer to the 2% level. And I even throw out that over time, a strategy to get yourself down to more like 1.75% is really in the high performance area for net overhead. Once again, it doesn't matter how you do it, increasing non-interest income or cutting non-interest expense or some of both is really part of developing a net overhead strategy. But I think my feeling is for the industry, more efficiency in terms of net overheads is very important. And then, as I've talked about before, the third driver in terms of effective tax rate, that once again, as ROAs have moved up, we also saw a move up in terms of ROA, there in terms of effective tax rate, but then moving down a little bit, but still this is way too high at close to 30%. So one needs to figure out a tax strategy. Can one get themselves down to more like 20% in terms of an effective tax rate? And where in some banks that may not be possible, the thing is that for all banks is that you should be able to get that effective tax rate down somewhat. So when we look at those two strategies in terms of the net overhead and looking at it from the standpoint of tax efficiency, my feeling is that the industry overall can move back up into that 1% ROA level. This is Jay Brew, co-chairman of Seafreedom Brew. Have a great week.